Mystified by net working capital? Not sure what exactly net working capital is? Hello, my name is Ted Breslin. In the next several minutes, I am going to help guide you to a better understanding of the mysteries of net working capital. Before we begin with that understanding, let's review some things you already know about business. Most businesses are trying to earn a profit. To accomplish this, businesses provide either products or services or both. Some examples of businesses would be screen door manufacturers or envelope manufacturers, an accounting firm, or a house cleaning company. Each of these examples provides a good or product or a service. Some businesses may provide a combination of both. The house cleaning company may provide office or residence cleaning services and also offer cleaning chemicals at retail to their customers for self-maintenance. Now let's go over some terminology you should be familiar with in order to be able to fully understand what net working capital really is. We will be taking a look at current assets, working capital, current liabilities, and then finally a more detailed discussion of net working capital. Let's begin with current assets. To be able to operate as a company, many things are necessary to carry on day-to-day operations. Businesses have to have some money in the bank, also known as cash. And once the product or service has been sold, often on credit, the money or proceeds from that sale must be collected from customers at a later time. This is called accounts receivable, the money owed to a business for goods or services provided. And in the case of businesses selling products, there must be some level of inventory maintained in order to meet the customer's demand for the product immediately, so they do not have to take their business elsewhere. This is called inventory. These three things, cash, accounts receivable, and inventory, make up the current assets of the business. Simply stated, current assets are essentially the working capital of the business. That's right. It's nothing more than the sum of current assets, cash, accounts receivable, and inventory. These are the working capital. Now, let's take a look at another type of business account called current liabilities. For the purposes of our conversation, current liabilities will be called accounts payable. Accounts payable are simply unpaid bills the business has in-house that must be paid within a relatively short time, typically 30 days. The bills may be for electric, supplies purchased on account with a supplier, and so on. An invoice or statement is typically entered into the accounting system for payment within the specified time period and paid to avoid any late penalties. However, anything owed to other businesses that is due under 12 months is typically considered to be a current liability. Businesses use a lot of measurements to determine whether they are operating within safe guidelines. These measurements are sometimes referred to as ratios. Some common ones are the current ratio, the quick ratio, the return on capital, and debt to equity, and so on. It is not necessary to understand all the ratios at this time, but one, the current ratio, is a calculation that is a close cousin of net working capital. The current ratio is calculated by dividing current assets by current liabilities. Although some industries may differ, a current ratio of 2-to-1 is considered to be sound. The ratio is mainly used to give an idea of the company's ability to pay back its short-term liabilities, meaning debt and payables, with its short-term assets, cash, inventory, and receivables. The higher the ratio, the higher the current ratio, the more capable the company is of paying its obligations. Now, you may recall that working capital is the sum of current assets. Net working capital is simply the sum of current assets less current liabilities. It is easy to see that net working capital can be affected by changes then in either current assets or current liabilities, and the management of net working capital will have an impact on additional financing and investment decisions a business may consider in the future. Therefore, it is pretty easy to understand why net working capital of businesses is pretty important. Thank you.